Hello and happy new year. And welcome to the What's Up a Real Estate Show. I'm your host, Mortgage Mac, and today we're talking about a market that is definitely shifting gears. And just need a haircut. And mortgage rates have stayed in the low 6% range for a couple of months now and seem to be headed lower. Transactions were picking up, seemed to slow down over the holiday period, but that direction seems to be changing as well. And the economy is signs of slowing based upon the latest ADP and JOLTS report, which we're not going to discuss today, but we are going to dive into the most recent action on the part of the administration. And joining me today, as always, is the one, the only ChatGPT 5.2. And she reads all the reports so we don't have to, and always insightful, never late, and always on time. And all this and more news you can use for the weekend in January 2026. It's 2026, and I'm your host, Master Mortgage Mac. First name Mortgage, last name Mac, and we believe in building relationships with buyers and real estate agents that help everyone win. And so, thank you for being here today. Let's move on to our breaking news. And hey, you know what? Who's running the monetary policy? I thought the Feds were supposed to do this. Before we get into today's data, we need to pause for breaking housing and financial news. Reports indicate that a $200 billion intervention into the mortgage-backed securities market tied to administrative action, and involving Fannie Mae and Freddie Mac. And today, we're not here to say whether this is good or bad. We're here to ask some very important questions. And is it wise? Is it lawful? And is it consistent with our financial policy here on a national basis? So let's bring Sol in here. Sol, has a president ever in the history of the United States ever taken any actions similar to this for the sole purpose of stimulating the mortgage market outside of the Federal Reserve? Let me turn on Sol. Uh-oh. Uh-oh. Sold out on me here. One second. Hey, it's been one of those days, so we'll be on track here. Sorry. Here we go. Hey, Sol. So, has a U.S. president ever directly initiated something that resembles quantitative easing, like what we saw this past week from the administration?
Well, it's definitely a rare move. Traditionally, something like quantitative easing is in the Federal Reserve wheelhouse rather than a direct presidential initiative. So, what we're seeing now is quite unusual, and not really something we've seen in this form before. It definitely raises some interesting questions about the boundaries between fiscal and monetary policy.
Yeah, definitely. What does executive authority? Where does executive authority end and monetary authority begin as it relates to the current mechanics that govern U.S. U.S. policy as it relates to Fannie Mae, Freddie Mac? Is the administration under its current um, lawful capacity, as best you know, and to be a lawyer for us, and give us a take on this, please. Is this a lawful action? Clearly, I think everybody in the mortgage business welcomes this because we've been through some pretty rough patches here over the last couple of years. What do you say?
Absolutely. Let's break it down a bit. So, as best as we know, the executive branch does have some leeway when it comes to directing agencies like Fannie Mae and Freddie Mac, especially since they're under federal conservatorship. That means there's a certain lawful capacity for the administration to influence these kinds of actions. But it's definitely a gray area because traditionally, monetary policy is the Federal Reserve's territory. In other words, yes, it's likely within the administration's legal reach given the structure of these agencies, but it's unusual and it does raise questions about the balance of authority.
Fair
And of
enough.
course, from the
Fair enough.
mortgage industry's perspective, it's a welcome move if it helps stabilize rates and bring some relief after some challenging times. So it's a
Yeah. So let's talk about the mechanics, though. Where does the $200 billion come from? Does it come from Fannie Mae's retained earnings? Does it come from the Federal Reserve? Do you know?
Absolutely. Let's talk about that. So, the $200 billion dollars in this scenario could come from a mix of horses. It might be drawn from Fannie Mae and Freddie Mac's retained earnings, since they do have some profitability under their belt, or it could involve some form of liquidity or backing that is ultimately connected to Federal Reserve mechanisms. In essence, it's not just money appearing out of nowhere, but rather a coordinated use of available funds and financial tools that these agencies can access. So, it's a bit
So,
of both, and that's what makes
so,
it an unusual but interesting move.
is it likely that the Federal Reserve is printing money to utilize to buy up mortgage-backed securities, and could this be inflationary on a long-term basis?
It's definitely a possibility. If the Federal Reserve is effectively expanding the money supply to buy mortgage backed securities, then yes, it could have inflationary implications down the line.
That's what I
It's one of
thought.
those moves that's intended.
Yeah, yeah. Hey, sorry, but that's what I thought, and I think it, could have the opposite impact. I mean, I think Thursday we saw a rally. Yesterday, much of that was taken back, and we sort of, turned the other direction. Could have been profit taking. Nothing that is a pattern that we should rely on at this point, but it's through the market. It generated a great deal of market activity. Let's put it that way. So, with that in context, let's move into our first talking point. Regardless of policy debate, behavior seems to be changing in the market. So, let's discuss that now. And nationally, we just saw a 3.3 month over month increase in the pending home sales index, bringing it to 79.2, the highest level since February 2023. That tells us, hey, you know what? Buyers might back in the market. And let's unpack that and see what that means for Houston. And, could you sort of give us a rundown on where Houston is as it relates to these two figure, the average mortgage rates and the pending home sales index, please?
Absolutely. Let's dive into that. So, with that 3.3% month over month increase in pending home sales nationally, we're seeing that buyers really are stepping back in. For Houston, the story lines up similarly. The Houston market has been pretty resilient, and with mortgage rates coming down, we're also seeing more local buyers willing to write contracts rather than wait on the sidelines. In
Yes.
terms of the average
Yeah.
mortgage
So
rates, Houston tends to follow the national trend pretty closely. So, with rates around that 6.16% mark, it's creating a bit more affordability and nudging local activity up. Overall, Houston's pending sales are reflecting out same buyer confidence, so the market's definitely picking up momentum locally as well.
yeah. So it could be a clear indicator for a good 2026. And I've come into the year cautiously optimistic. This is my 34th year in the mortgage business. Hey, I know I don't look like that, right? Look, well, let's see, maybe I do. So, um, are you more active now than 6 months ago? If you're watching and you have a perspective on this, we'd love for you to give us your take on this most recent action, especially if you're, say, in the mortgage business or the real estate industry. And, when activity returns, prices usually follow. Let's talk about that now with the most recent Case Shiller price index for talking point number two. And Cake Shiller shows national home prices rose 0.4% month over month in October, following gains in the August and September. Year over year, growth is still modest, but the direction matters. And this comes off of several months of decline, going back to, say, what, March of 2025. Um, We've been cautious as it relates to. We've been cautioning sellers about these expectations. Were those cautions still correct? I mean, it looks like we're headed the opposite direction from the trend that we thought we were seeing in the spring, maybe summer of 2025. What's your take on this, please, ChatGPT?
Absolutely, and that's a great observation. So, we are seeing a bit of a shift in momentum here. Earlier in 2025, we were definitely advising sellers to be cautious because the market was softer, and that was the right call at the time. But now, with the Case Shiller Index showing a few months of modest month over month gains, it does look like the direction's turning a bit more positive. So, in short, our client earlier was correct for that period, but the market's dynamic, and it looks like we're now seeing a bit of a turnaround. That means it might be time for sellers to revisit their expectations and realize that the market might be tilting in a more favorable direction for them as we head into 2026.
Yeah, I think all of this really hinges on one number. What is that number?
Well, it really comes down to mortgage rates. That's the big number that's driving so much of this change. As rates have come down, we're seeing more affordability and more buyer activity, and that's what's nudging prices and sales upward. So if we had to pick one key figure, it's that mortgage rate. It's the lever that's influencing buyer confidence, seller optimism, and the overall market direction.
Yeah, if you're out there listening, go check out mortgagemac.com. I saw rates today published by my team at 5.9%. So looks like we're slightly under 6. Finally, finally, finally. Now moving on to talking point number 3 and approaching that 5% conversation. Wow, okay, great transition here, great segue. And let's talk about the numbers everyone is watching most closely. According to Freddie Mac primary mortgage market, the average 30-year fixed rate as of January 9th, 2026 came in at 6.16. That's down meaningfully from 6.93 one year ago and well below the 7.79 peak in October 2023. If rates were to move into the 5% range, we'd be talking about levels we haven't seen since September 2022. And I remember September 2022. We thought, oh my goodness, rates are 5%. And we're not at 5, but we're closer. And then we've been, only for rates to go that low, there's generally some sort of catastrophic economic event. Let's hope we don't have that. So share with us local data in Houston as it relates to mortgage rates, please.
Absolutely, and that's a great context to set. So, locally in Houston, we're generally seeing rates following that national trend, hovering just slightly above or below that 6% mark as well. If we're seeing 5.9% on your team's latest update, that lines up perfectly with the idea that we're inching closer to that 5% conversation. And you're right, when rates dip this low, historically, it often has been tied to some major economic event, but hopefully this time we're just seeing a more stable and positive shift. For Houston, that means more buyers can afford to get off the sidelines, and it might bring a bit more balance as opportunity into the local market as we move forward.
Thank you for that. Thank you for that. Moving on to this week's mortgage tip, financial fitness for 2026. Getting financially fit before you shop is like training. The Houston Chevron Marathon is this weekend, and the better you train, the stronger you finish. And I used to be a guide for blind athletes, not many many years ago, but a decade ago. Let's put it that way. So a decade ago, and I went to an event last night to raise money for blind athletes and for an organization that's devoted and committed to helping blind athletes achieve astounding things in their lives. And it was just an amazing event. It's called ICANN Alliance, and just an amazing, amazing group of people. And so, hey, you need to know your credit, understand your budget, and have a plan for reserves. And confidence beats chaos every time. It just does. Confident in chaos. And the I can't say enough about how challenging it can be if you just don't have your paperwork together. And another great example is I had a gentleman today ready to make an offer, and I know the holidays are busy, and bless him, he's got single dad, 4 children, and so we finally connected today, and just not ready, and so what we did is we spent an hour on our Saturday to help this person be able to execute to purchase a home when the tax returns are done in 2025. So, and while the preparation matters, homebuyers, the same kind of planning and discipline applies to business. And so, with that said, we're going to move on to this week's Stoic quote. And every week, we like to take a step back from the noise and ground ourselves with a little perspective. Here's this week's Stoic quote, and it's especially relevant, I believe, relevant to today's not just real estate market, but today. And small-minded people blame others. Average people blame themselves. Wise people see all blame as foolishness. And for me to put that into context, we're debating a lot of things today, and that's just it. We're just busy debating and blaming, debating and blaming, debating and blaming, and nobody's actually corroborating. And then if you say, "Hey, maybe we ought to get together and try to solve these problems together." People don't want to do that today. It seems like just don't want to do that. So, un momento, mommy. And then, hey, sorry, I promised my wife I'd take her shopping. And so, how does this mindset apply to money, markets, and leadership, ChatGPT?
Absolutely. And that's a powerful Stoic insight. It really does apply directly to how we approach not just markets, but life in general. When we step away from blame and finger pointing, we actually create room for collaboration, problem solving, and real leadership. In the context of money and markets, that means focusing on the factors we can control, staying adaptable, and working together to find solutions instead of getting stuck in the blame game. So when we apply that mindset to leadership and markets, it's all about taking a step back, seeing a bigger picture, and encouraging others to work together toward productive outcomes. And that's exactly what we aim to do here. So thanks for sharing that, Cord, by making the connection.
Thanks, Soul. Let's have a little fun with puns today. Dun, dun, dun. Two monocles had a spectacle of. You got this, Soul. You got this, Soul. Two monocles made a spectacle of.
Aha! I see where you're going with this one. Two monocles definitely made a spectacle of themselves. Love it and always ready for a good pun. Thanks for bringing the fun.
Yep, Dutch toilets are all frequently clogged. Laugh out loud. Is that really funny? Come on, folks. Let's do a fake laugh in the back. Hey, hey, a beehive with no entrance on the. And you know what? I put one from Postmates, and they're terrible. And you know what my favorite one is? Ooh,
Well, those are some top tier puns for sure. And hey, a little fake laugh never hurts to get the fun rolling. So, yes, Dutch toilets might be frequently clogged, a beehive with no entrance is unbelievable, and yes, puns on post its really are terrible. And if your favorite is that bad puns are how I roll, well, it's a classic for a reason. Always good to wrap up with a bit of humor.
Thank you for that, Soul. And so let's move on to hey, one second. We had the privilege of having a TikTok video that went above 50,000 in views. I would like to say likes, but views, and we're going to play that for you now. So funny. A fairy
Absolutely.
tale who never bathes. Stinker Bell. Hey, if you're on TikTok, go to our TikTok at #MortgageMac. Look, we just like to have fun and play on TikTok. Right? That's all we're trying to do, and you know, try not to be offensive, try not to be too serious, and we try not to take ourselves too serious. So we hope you enjoy these puns, and we'd love to hear your favorite pun. Maybe we'll feature it on the show sometime. So. Okay, let's close it out. We're moving rather fast today because we promised my wife I would take her shopping. So thanks for joining us for this week's episode of What's Up with Real Estate. Thanks to our sponsors, Rate.com and List Reports. Please subscribe, follow, share with this episode. And if you want to plan, not a pitch, book a time with Mortgage Mac. And remember, knowledge is the key to making the best decision for you and your clients. Join us every Saturday at 10 a.m. right here on LinkedIn, YouTube, LinkedIn, Facebook. Until next time, stay engaged, stay informed, and I'll see you at closing.